Okay, good afternoon, everyone, and welcome to today's webinar. My name is Megan Peasley, and I am the Iowa Sourcing Program Coordinator at the University of Northern Iowa's John Papa John Entrepreneurial Center. Here, we work with the Iowa Economic Development Authority to bring the Iowa Sourcing platform to all business owners. Whether you're looking to start, grow, fund, or even exit your business, Iowa SourceLink is here to help you. We provide step-by-step guides, make helpful referrals to our nearly 400 partners, and house the Business License Information Center. We also have the pleasure of presenting these webinars in partnership with the Iowa Department of Revenue. In today's webinar, Kurt Koenig will be providing an overview of individual income tax updates based on previous filing years and tax law changes. Before we get into that, I have a few housekeeping items to go over first. Today's webinar is being recorded and will be available within the next week. You will receive a link to today's recording in the same email you will receive as proof of your attendance. Second, the slides for today's webinar will be shared momentarily in the chat box by Sophie Troxel. Sophie and I will also be sharing other resources and contact information if and when they're brought up during the webinar in the chat box. Please enter any questions that you have in the Q&A box located in the bottom half of your screen. We do ask that you focus on asking general questions that can apply to everyone. If you have a question specific to your situation, we recommend that you talk to the Department of Revenue directly. We are going to hold off on answering the questions that come through until the end, and if there isn't enough time to get through all the questions, don't worry. All the questions will be sent to Kurt along with your contact information. And with that, Kurt, I'll let you take it away.
All right, thanks, Megan. And thanks, everybody, for joining us today to talk about individual income taxes. Before we get started, I want to go through our disclaimer. I just want to remind everybody that everything I cover today is for educational purposes only. Nothing is intended to be binding guidance. If you do want binding guidance, you can request or you can file a petition for a declaratory order, and then you could use that information. But rolling forward, this slide has our mission, our vision, and our values. Just briefly, I just want to make sure that people understand the department really just wants to receive the tax revenue that the state's entitled to. We don't want to receive any more tax revenue, and make sure that the taxpayers are only paying their fair share of taxes. And we strive to make it easy to comply with the tax filing obligations in the state, and that's why we work hard to constantly improve the forms and instructions. Here's an overview of what I plan on covering today. We're going to start off by talking about tax year 2024 legislation. And for those of you that just want to sit in and find out what's new, this will be a quick presentation for you. But other than that, we're going to go through and we're going to talk about some provisions going all the way back to tax year 2018 that impacts the 2023 tax year and the 2024 tax year. And then we're going to finish up by going through just some common filing issues that we've recognized and we want to make you aware of, just so that everybody's complying with their tax filing obligations and preparing the forms correctly. Okay, with that in mind, we're going to go ahead and jump into tax year 24. And here are some of the provisions that passed this past year. First, House File 2649, this brought back the livestock capital gain exclusion. And this is very similar to the old capital gain deduction, where if you've got cattle or horses and you held those for 24 months and you sold them at a capital gain, not ordinary, but at a capital gain, and at least 50% of your income is from farming or ranching, you're able to exclude those capital gains. Also, if you have other breeding livestock and you've held that livestock for 12 months or more, and again, you have more than 50% of your gross income from farming, you're able to exclude those capital gains. So we've brought this back again. Something that's a little bit different than the old provisions is that you can't exclude the gains if the sales were to a lineal descendant and you didn't meet these holding periods. That's the only thing that's really different. We've modified the Iowa 100A form for tax year 23, because you can see at the bottom of this slide, this is effective retroactively back to January 1 of 23. So you're able to go back and amend the 2023 return, or if you've extended your return, you can file an original return. But I want you to know that you have to file that on the new form that we posted on our webpage, and you're going to have to submit that tax return on paper, just because the MEF programs, the modernized e-file programs, probably are not going to be updated with the software vendors. So submit those on paper, and then we'll get those returns processed and issue any refunds that may be due. Another provision is House File 2680. What this did was really expand the retirement income exclusion. And this will apply to spouses of deceased taxpayers that were employed in like a protection occupation. So even if the decedent wasn't eligible to claim the capital or the retirement income exclusion, they weren't age 55 or older, they weren't disabled, and the spouse is not age 55 or older or disabled, as long as they receive retirement income from one of these qualifying plans, the income is excludable by that taxpayer. And for purposes of this provision, the retirement plan has to be a plan that's identified pursuant to one of these sections. So these are like IPERS covered plans, and I think there's a sheriff's plan and a firefighter retirement pension plan. All those would be eligible for the retirement income exclusion. As I mentioned before, the decedent doesn't have to be age 55, didn't have to be age 55 or older or qualify to exclude the retirement income, neither does the spouse. If you do have this income that qualifies for the retirement income exclusion, you're going to report that on Schedule 1, Line 7, and you'll include that with the other retirement income that's reported on the tax return. And this is effective retroactively back to January 1 of 2024. There's also another new provision from tax year 23 from House File 2661, and this provides for a refundable tax credit of up to $2,000 for moving expenses for public safety personnel that become a new resident on account of taking employment in the state of Iowa. And for this purpose, a new resident, that's going to be an individual that becomes a resident after July 1 of 2024 upon taking full-time employment with the state, and they remain a resident and employed full-time up until the point that they take this credit. So keep in mind, I could take full-time employment in the state of Iowa after July 1 of 24 in one of these protective occupations. But if I don't file a return on time, and maybe I don't file this return until the end of tax year 25, at that time, I still have to be a full-time resident, and I still have to be employed full-time in this protective service occupation. And then the final bullet point on here is I'm not allowed to have been a resident of the state 12 months prior to the time that I gain residency again. So I can't leave the state and then move again and try to claim this $2,000 refundable tax credit. Public safety officer, I think I've got a link to our administrative rule that better explains what occupations we think qualifies. Our moving expenses that qualify, a lot of them are very similar to the federal provisions. They include things like your travel expenses, your meals, your lodging, when you're moving to the state of Iowa. But here is the guidance that we provided on July 1, and this is a non-exclusive list of public safety officer jobs that we think qualify for this moving expense tax credit. I'm seeing some questions come in, but they don't seem to pertain to the slides that I have right now. So I'm going to keep going right now, and I'll try to get back to some of those questions in a little bit. For purposes of this credit, if I pay or incur this expense prior to the date that I start full-time employment, or in the same year that I start my full-time employment, I'm going to claim this tax credit in the year that I gain full-time employment in residency in the state of Iowa. If I pay or incur the moving expenses in a year after I start full-time employment, I'll just claim the tax credit in that year. And again, this is effective July 1 of 2024. And here's a sneak peek at the Iowa 176 form. This is the form that you're going to claim the tax credit on. While we're on this, I just want to let you know also that we've finished up the forms for this year. We are providing them to the software vendors so they can start updating them. And then in November, we're going to give them test data so they can test the forms to make sure that they're working. And if you want to track your vendor, it would be in December, first part of January, but you can go to our website, type in modernize e-file or MEF, and it'll give you a list of all the different software companies and the forms that they've been approved for. I just want to throw that out. We do that on an annual basis. Another update that I have for tax year 24 is House File 2667. This had a couple provisions that might be of interest to you. One, it increases the maximum amount that a taxpayer can deduct for contributions to a 529 plan. It increases it up to $5,500. So that's some real money you're able to put away and deduct each year. And then the second provision is that it does allow you to make a transfer from a 529 to a Roth plan, similar to the federal provisions, without being required to add back the amount that you previously deducted that may have been used for a non-qualified use. And I've received a number of questions on this. This is effective back to January 1 of 24. But the big question is, can I put $5,500 in my 529 plan and then roll it over next year and still get my deduction on the Iowa return? And the answer is no. When you are going to do this rollover, if it's going to be tax-free, you have to comply with the federal rules. And we're looking at Code Section 529C3E. And the specific parts of these provisions, I've copied some of these out of the federal guidance. It needs to be a trustee-to-trustee transfer, pretty straightforward. The amount that's rolled over can't exceed the amount of the Roth IRA contribution limit. Okay, I think that's probably doable for some people. But on that third bullet point, the 529 account had to have been open for at least 15 years. So no, you can't just open an account and roll it. The beneficiary of the 529 account has to be the owner of the Roth IRA account. Both of them have to be the same person. And here's the other glitch in that planning opportunity that some people thought they had, is that the rollover can't exceed the amount contributed to the 529 plan for the 5th year prior to the date of the rollover. So if I make a contribution to a 529 plan today, I can't roll that over to my Roth IRA for 5 years. Otherwise, it wouldn't comply with the federal provisions and it would be taxable for Iowa purposes. This is kind of a big one. Senate File 2442. It reduces the individual income tax rate down to a flat rate of 3.8% for tax years beginning January 1 of 2025 or later. So that's a pretty big jump. We don't have 4 tax brackets anymore. And then the alternate tax rate, that's going to be set at 4.3%. I'm having a tough time thinking of a situation where the alternate tax rate is going to be lower than the flat rate at 3.8%, but that's what was passed. And then I also wanted to point out that the 3.8% is going to be used in the calculation of the PTEC credit for individuals that are non-residents. And it's also going to be used on the composite return for individuals when you're calculating the tax liabilities for those returns. Okay, and for people that just wanted to hear the 2024 legislation, hey, you can leave, you can go eat lunch if you want to, but I'm going to keep rolling on. I'm going to go back to tax year 23. There wasn't anything real big in this year to talk about, except I want to remind people that in Division 7 of Senate File 565, this authorizes taxpayers to act on behalf. It authorizes individuals to act on behalf of other taxpayers, on forms prescribed by the department. In short, this is the new disclosure designee section on the income tax returns for the state of Iowa. This is similar to the federal check the box option on a return that authorizes the department or the Internal Revenue Service to talk with a person identified on the return. It doesn't always have to be the preparer, but I would encourage you to possibly discuss this with your clients, the taxpayers, and authorize someone to talk to the department just in case a notice goes out and somebody needs to talk to the department. So take advantage of that. We spent a lot of time working through that process, and as far as I know, it's very successful, and it's a little bit quicker than the POA process. It's my understanding that the POAs now are being processed within a week, assuming all the information that's required is submitted with it. So that process is coming along nicely. But the nice thing about the disclosure designee option is that's indefinite. I can always talk about the 2023 income tax return with the department, which is different than the federal provision where you're only allowed to discuss that tax return with the IRS until the close of the next tax year. Jumping back to tax year 2022. Oops, I went the wrong way. Okay, we're going to talk about some of the capital gain exclusion provisions. Some we're not going to jump super deep into, but look, I want to review these. Last year was the first year that you were able to take some of the new capital gain deductions and like the farm tenancy exclusion. So now that we have 1 year under our belt, let's talk about those a little bit. I'll tell you about maybe some of the issues that we're seeing. Talk about how some of the forms have been modified this year after looking at some of the submissions for the current year. Let's start with the sale of qualified stock. And this is effective. All these capital gain provisions I'm about to talk about are all effective back to January 1 of 23. And this allows taxpayers to exclude a percentage of the capital gain from the sale of qualified corporation stock. And we'll talk about those in just a minute. But for tax year 23, they're able to exclude 33% of the capital gains from this qualifying stock. Coming up in tax year 24, it's going to increase to 66%. And then finally in tax year 25, 100% is going to be excludable for Iowa purposes. And this applies to the sale of common stock, preferred stock, voting or non-voting stock, but it doesn't count capital gains from the sale of stock rights, stock warrants, stock options, or debt securities. So an employee owner is an individual that owned this qualifying stock, which we'll talk about in just a minute. They've owned that for at least 10 years, and the stock was acquired on account of employment with a corporation. And I've got our administrative rule on that coming up in just a little bit. And they were employed at least 10 cumulative years in the state. So, or they're employed at least 10 cumulative years with the company. So I owned the stock for 10 years. I was employed for 10 years. Those are probably some of the main factors in that. Okay, keep going backwards. Oh, and now I'm going to jump into the administrative rules. When we talk about while employed, this is going to include capital stock that was received as compensation. So that could be stock maybe I was entitled to a bonus, and rather than give me cash, they gave me stock. I could sell that, assuming I met the 10-year holding period, and exclude the gain on the sale of that stock. But it also includes stock that was acquired from, you're going to think this is a conflict right now, but stock acquired from a stock right, stock warrant, or stock option. I can't sell a stock right and exclude that capital gain, but I can exercise a stock right. I can receive the stock, and then I can hold stock for 10 years and sell it and be eligible for this capital gain exclusion. On account of employment, that means the stock must have been acquired in a manner that's only available to employees of the corporation. And our administrative rules also state that capital stock that was acquired at formation in exchange for a capital contribution does not qualify. So hopefully that provides a little bit of clarity to you. A qualified corporation, this means a corporation that at the time of the first sale or exchange. So remember, we kind of talked about this last year, is once a corporation is a qualifying corporation, it'll always be a corporation. So at the time of the very first sale or exchange, the corporation had to employ individuals in the state for at least 10 years, had at least 5 shareholders for 10 years prior to the sale or exchange, and had at least 2 shareholders or groups of shareholders that were not related for the 10 years prior. So remember, at the time that I do that very first sale, and I'm not talking about just for that taxpayer, once taxpayer A makes this election and they identify this corporation, any other taxpayer can claim this exclusion, assuming they meet, the 10-year employment and 10-year holding period. A related party for this purpose is a brother, sister, aunt, or uncle. And a qualifying corporation also includes members of an Iowa affiliated group. And if there isn't an Iowa affiliated group, they must have employed individuals in the state for at least 10 years, and the affiliated group must have made a valid election to file a consolidated return. They had to file a consolidated return for this purpose. And then if you had a corporation that was party to a reorganization that was tax-free or substantially tax-free, those are included as well. So remember, the employee owner is entitled to make one irrevocable lifetime election, and I'm identifying one qualifying corporation. So potentially I could have worked for 2 qualifying corporations. I could have held stock in those qualifying corporations for 10 years, but I only can pick one, and the gain from that stock is what I can exclude. And that capital stock had to be acquired on account of employment. I just couldn't have gone out and opened like an E-Trade account and purchased ABC stock. It has to be on account of employment. And this election, it applies to all subsequent sales or exchanges within the next 15 years, within 15 years. So I've got the date that I sell, and then I've got the next 14 years that I can exclude gains from the sale of that stock. And this also includes capital stock that's been transferred from the employer to their spouse or to a trust for the benefit of their spouse. And the only requirement is that on the date of that exchange, that other person had to be the spouse of the taxpayer. If an individual dies before they make an election, then the spouse or the personal representative can make this election on behalf of that taxpayer. And then you're going to complete Iowa 100J if you want to claim this capital gain deduction. I'm not going to go through the form. Retired farmer lease exclusion. I've been receiving a lot of questions on that. What this provision does is allows taxpayers to exclude net income from a farm tenancy agreement when they've held the property for at least 10 years and they've materially participated in a farming business for 10 years or more. Some important things is that the farm tenancy agreement has to be in writing. Many of you know I was in practice for a number of years, and when I was practicing, it was very common for especially related taxpayers to operate off of a handshake. But if they want to exclude their farm tenancy income, we need to have a written agreement. And then for a definition of what a farm tenancy agreement is, we look at Iowa Code section 562.1A. And what we've identified is a cash lease arrangement. That's where somebody agrees to pay me $300 an acre and they go out and they farm the land. Or you might have a crop share arrangement. Back when I was practicing, it was common to have a 50-50 arrangement where I agree to pay half of the fertilizer, the seed, the lime, the repair and maintenance, and then in turn, I get 50% of the proceeds from the sale of corn and the sale of soybeans. Or we can have a livestock share arrangement. In that case, you just substitute cattle for like corn and beans. For this purpose and the capital gain exclusion that we're going to talk about in a little bit, an eligible individual is a taxpayer who's disabled or age 55 or older, and they no longer materially participate in a farming business. That means they no longer have grain in their bins that they're selling, or they no longer have livestock that they're selling off, and they're not getting a K-1 from a farming partnership that they're a general partner in. And also, the owner leaser has to be a party to the agreement. So I can't have a cash rent arrangement with my brother who turns around and does a crop share arrangement with their neighbor. I've got to be a party to the agreement. And the definition of material participation is the same as the federal definition under 469H of the Internal Revenue Code. I'm not going to go through the definitions. I just wanted to list them, but I'm not going to go through the definitions of what a farming business is and what livestock is. But I do want you to know that if you do make the single lifetime election to exclude this farm tenancy income, you can't make the single lifetime election to exclude the capital gains, which we're going to cover in just a minute. And that's a little bit different than the capital gains that you're reporting on the Iowa 100A for the sale of breeding livestock. And also, in the same year or succeeding years, you can't claim the beginning farmer credit. Even if there's a carryover of a beginning farmer credit, you can no longer claim that credit. Otherwise, you're going to be required to go back and pay tax on all the years that you excluded this retirement income. You could be subject to penalty. You could be subject to interest in those years as well. Married individuals who file separate returns, seems pretty straightforward, but you're just going to report your share of the farm tenancy income and expense on your tax return. Partnerships, S corporations, trusts, and estates, these pass-through entities, they're not eligible to claim the farm tenancy lease income exclusion, and also the individuals who receive that income on a K-1 from a pass-through entity, they're not able to claim this exclusion either. We've modified the Iowa 125A form just a little bit. When we originally created the form, we used some of the languages that was contained on some of the old capital gain deduction forms. And this year we're going to modify it so that we're focusing on the farm tenancy agreement. I think that is probably easier to reconcile and understand. So if I'm a single individual and I have a farm tenancy agreement with an individual and they lease all my farm, and I might have different holding periods on the farm, but they're all at least a 10-year holding period, I might be able to just complete one Iowa 125 form and exclude the income. If I own this property jointly with my spouse, and they also make an election to exclude the farm tenancy income, then we need to complete two Iowa 125 forms. If the spouse doesn't make the election and they jointly own the property, then potentially only half of the income, farm tenancy income, is excludable on the land. So I just wanted to run through some of that stuff. If you have questions on it, let me know. Now I'm going to jump ahead to the retired farmer capital gain exclusion. And again, there's a couple definitions in here. I'll let you guys read those on your old time, but I'm not going to skip over the slide that has the definition of a relative. And for purposes of this capital gain exclusion, a relative is either an individual that's related to the taxpayer by blood, consanguinity, or affinity by marriage within the second degree, or it's a lineal descendant, it's a parent, grandparent, child, grandchild, or it's an entity which has an individual that meets one of these conditions above. So it might be a grandchild that has an equitable ownership interest in a pass-through entity, a partnership. So they might have a 1% ownership interest in there, and they're considered a relative for this purpose. Similar to the farm tenancy exclusion, qualifying taxpayers either have to be disabled or they have to be 55 years of age or older. And again, they can no longer materially participate in a farming business. So if you've got real property used in a farming business, this is where things are going to get just a little murky for you. I can sell real property that I've used in a farming business, and I could not be retired right now, and I don't have to make the single lifetime election to exclude this income, but I have to materially participate in the farming business for 10 years, and I had to hold the real estate for 10 years. And if I'm not retired, that 10-year material participation has to be the 10 years immediately preceding the year that you sold that property. Or you can see in bullet point B here, I can sell this property to a relative, and then I don't need to meet those other holding periods. But okay, I'll get to my other thought here in just a second. Okay, I'm jumping now into the capital horses, the breeding livestock. I'm sorry, I'm getting tongue-tied. But for purposes of the capital gain exclusion, I can also exclude the sale of cattle or horses similar to the Iowa 100A, as long as they're held for a 24-month period, or I can sell other breeding livestock that I've held for at least a 12-month period. If I make a single lifetime election to exclude all the capital gains, and when I make that single lifetime election, when I'm a retired farmer, then I can sell the real estate, I can sell the cattle and horses, I can sell the breeding livestock, and I can exclude all those. And if I'm a retired farmer, the rule changes a little bit. Remember, I said if you're not retired, your material participation had to be 10 years immediately preceding the year of sale. If I'm a retired farmer, it's any years of material participation in a farming business. If people are claiming the beginning farmer credit, if people are claiming the capital gain deduction, they can't claim the beginning farmer credit in the same year as succeeding years, similar to the farm tenancy provisions, and they can't exclude farm tenancy income. So it's one or it's the other. I can't exclude farm tenancy income and the capital gains. Again, with married individuals that file separate returns, you're just going to report your share of the capital gains on your return and exclude it and make the single lifetime election. Something that was contained in House File 2317 that I wanted to make you aware of is installment sales. Remember, before we had a number of different capital gain deductions. We had some for sales of stock to ESOPs. We had sale of real property that wasn't used in a farming business. We had a capital gain deduction for the sale of a business. And originally, if they were sold under an installment arrangement and proceeds received in tax year 23, we didn't think that they were going to be eligible to take the capital gain exclusion. It was cut off December 31 of 22. And with House File 2317, it clarifies that if there was an installment sale that previously qualified for the capital gain exclusion, and then proceeds are received after January 1 of 23, they're still eligible for the capital gain exclusion. So we still have all those other Iowa 100 forms out on our site for you to claim those deductions. Surviving spouses of a deceased taxpayer. A couple things: if a taxpayer dies and they didn't make an election, a surviving spouse could make an election for that deceased taxpayer to claim, like the farm tenancy exclusion, or claim the capital gain deduction. But if a taxpayer made a previous election to exclude, let's say, farm tenancy income for this purpose, the surviving spouse does have the option to disclaim that election. Let's talk about this. So a taxpayer dies, they make an election to exclude farm tenancy income. The surviving spouse is going to be able to continue using that election by the deceased taxpayer only on the property that was inherited. So I inherit property A, there was an election to exclude the farm tenancy income. I could just continue on excluding that. Even though I don't qualify, I can exclude that farm tenancy income forever. And on my other property, when I'm eligible, I can make my own election on the other property. Let's say, same scenario, I inherit that property and the taxpayer made the election to exclude farm tenancy income, and I don't want that. The surviving spouse maybe decide that they want to sell everything and take the capital gain deduction. What they could do is they can disclaim the election by the taxpayer, and they have till the due date of the tax return in the year following death to disclaim the interest that was made by that taxpayer. And on this slide with this administrative code, this just points out that if you've got a retired farmer, when we're looking at material participation, we're looking at any years any participation, any 10-year material participation. If they're not a retired farmer, then we're looking at 10 years immediately preceding the sale. And then if you've got real property that's sold by a partnership, S corporation, or limited liability company, this rule just clarifies that pass-through entity had to hold the property for 10 years, and then the individual that's claiming the capital gain deduction needs to show that they materially participated in a farming business for 10 or more years, not necessarily 10 years in that pass-through entity, but I've got to show that I materially participated in a farming business for 10 or more years. Also in House File 2317, we removed the limitation related to the retirement income exclusion. Previously, if you were a married taxpayer and you filed a joint return, you could exclude $12,000 retirement income if you're age 55 or older or disabled, or any other taxpayer, you could exclude $6,000, and that limitation's been removed. So if I'm age 55 or older or disabled, I can exclude all my retirement income, which is good for people that are retired. And then they've also modified some of the provisions related to the thresholds of when you're required to file a return. Kind of like if you're a single individual, the threshold is like $9,000, or if I've got taxpayers filing a joint return, they're both age 65 or older, the threshold's $32,000. And this provision removed the requirement to add back the amount of retirement income that was excluded to see if I've met that threshold or not. So kind of a big deal. So potentially fewer taxpayers may be required to file a tax return in the state of Iowa. Here's some of the qualifying plans that we identified in our administrative rules. We're talking about distributions from these plans which would qualify for the retirement income exclusion. So you can see we're looking at traditional IRAs, distributions from Roth IRAs, conversions from a traditional to a Roth IRA. I specifically want to point out the plans that we say don't qualify, and that'd be a non-qualified deferred compensation plan. I get a lot of questions on that. And non-qualified annuities. If I have an annuity that's housed in a 401k plan or an IRA, distributions from that would be eligible for the retirement income exclusion. But if I just go purchase an annuity and it's not part of a retirement plan, all distributions from that are going to be taxable for Iowa purposes. Then 2018, it's kind of funny we're jumping back that far, but a lot of these provisions came into play in 2023. But I just want to point out a few things. Most of you know by now, if you completed the 2023 return, that the starting point for Iowa taxation for individual income tax purposes changed from federal adjusted gross income to federal taxable income. I mean, that's kind of the starting point. We ask for additional information on the Iowa 1040, and then we allow for modifications that show up on Schedule 1 of the Iowa 1040. But net operating losses, right now, what you're allowed for Iowa purposes is the same net operating loss that's allowed for federal purposes, with some modifications, which I've noted on the slide, is if you've got a pre-23 federal net operating loss, then you're required to add that back, and you're going to add it back on Schedule 1. But you're also allowed to deduct any pre-23 Iowa net operating losses. So you'll take the federal NOL, it's already included in your federal taxable income. On Schedule 1, you're going to add back pre-23 federal net operating losses, then you can deduct the pre-23 Iowa net operating losses. AMT was repealed for Iowa purposes, and you had a 1-year period where you could claim that AMT credit carryover, and that 1-year period is gone. Tax year 23 was the year that you could do that. So now AMT is gone. We've modified our forms. We've removed that AMT credit form. So that should make both of our lives just a little bit easier. And then we had a 1-year period for federal tax deductibility. So in tax year 23, on the Iowa return, you could deduct the amount of federal taxes that were paid for tax year 22 and prior. So that would have been the tax return that showed up on the 2022 federal 1040. And it could also include possibly that estimate that was paid in January of 23, federal income tax estimates that paid in January 23 for tax year 22. So that's all gone. And then when we get to our common issues problem, you're going to see that an issue that we had this year is taxpayers were still trying to deduct the amount of federal withholding that was showing up on W-2s. And you can't, because that was for tax year 23. It wasn't for a tax year prior to tax year 23. So we've identified a bunch of those. Some taxpayers are getting notices because of that. Okay, we're going to jump into some common filing issues to help us both for this coming tax season and maybe while you're filing amended returns for this year. The first thing that I have on the list is that taxpayers aren't checking the box identifying a 1040 as an amended return. And when you don't do that, it delays processing on our end, because we end up with 2 copies of return and we're trying to figure out, does one just supersede the other? Is one invalid? It just creates additional work on our end. So please check that box so that we know it's amended return, and also make sure that you have a copy of the Iowa 102 attached to that form as well. If you submit a tax return electronically, don't turn around and send a paper return into the Department of Revenue. Again, that's something that can delay processing times. When you submit a return electronically, you should be able to get a receipt from the software company. You should be able to go online and check the status of any refunds. Just please don't send us 2 copies of a return to make sure that we have it. Similar to prior years, a number of returns reported an incorrect amount of estimated tax payments that were made on the return. And again, I mentioned before that previously I was in public practice, and I get it. A number of times you're meeting with clients and you say, hey, you paid the estimates that I gave you last year on time, right? And they shake their head, yes. And then you find out they didn't. They missed payments. They sent in different dollar amounts. They didn't send them in on time. But just make sure that you have the correct amount of estimates and the dates that they were paid, just so it doesn't create problems for both of us. And as I mentioned before, some taxpayers are claiming the amount of withholding that shows up on their W-2s or their 1099-Rs as federal tax paid for a prior year, when it's not. That's tax that was paid for tax year 23. So taxpayers wouldn't be eligible to deduct that. And on our 1040, we've removed the lines now for the deductibility of federal taxes, because as I mentioned earlier, that was a 1-year deal, a transition period where you could deduct the prior year taxes. So those lines are gone on the returns for tax year 24. On the next one, they're saying that taxpayers aren't adding back the correct amounts when they're determining whether they're eligible for the low income exemption, or whether they're calculating the alternate tax or tax reduction. I've got a worksheet coming up here that shows you what you should be adding back when you're trying to determine whether you're eligible for the low income exemption. I just want to remind you, for the livestock capital gain exclusion, if you're going to claim that for tax year 23, use the paper form that we have out on our webpage, because that's different than the one that was released at the first part of the year, submitted on paper, and then we'll get that processed. Our amended return inventory, the last I checked, that was at roughly about 6,500 returns. I have that listed under PTEP because I know a lot of taxpayers amended like their 2022 returns. They filed amended individual income tax returns, and a lot of them are waiting on refunds. But what I can tell you is the number of amended returns is roughly 6,500. I can't say that they're all PTEP, because there's a number of reasons why an amended return might come to the state. 6,500, that's really not a large number of returns. We're actively trying to process those now that tax filing season's done, so hopefully we can be caught up fairly soon with those. Something that was new last year is if a taxpayer was a farmer or a fisherman. I don't think we have a lot of fishermen in the state of Iowa, but I don't know. And if they either paid an estimate by January 15th, or if they filed their return by March 1st and paid all the tax due by March 1st, and they were eligible for the exclusion from the underpayment penalty, they still need to complete a 2210F. There's a box that you check at the box of that. Sorry, I'm getting notifications. There's a box that you check at the top of the 22F form. And even if it calculates a zero penalty, submit that with a return. We need that. And then we know not to send out an underpayment penalty statement to you. There was a number of taxpayers that did receive notices indicating that they paid late and they owed tax, and that was because they didn't submit the 2210F and they didn't check the box on line 35. Talking about PTET credits, there were a number of amended returns that came in. A common issue that we found with it is that they didn't include the Schedule CC, which provides us with information of the entity that passed this PTET credit out. Similar to withholding, with our system, we try to match up all those credits, kind of like withholding. We tie those out to W-2 forms. If there's a PTET credit, we trace that back to the entity and make sure that the amount that's reported is correct. And if you don't give us that Schedule CC, we can't validate the credit amount and it's going to be denied. Another issue that we saw on the Iowa 148 form, this is a form where you report your refundable and non-refundable tax credits. For tax credits that have tax certificates, it was common for a number of taxpayers to incorrectly report the tax certificate numbers. So again, just like with everything else, we validate the tax credit and we need to have valid, accurate tax certificate numbers so we can confirm that the amount that's reported on a tax return is accurate. Otherwise, unfortunately, we have to deny that credit, and that's an uncomfortable situation for you or your client or for us. I mentioned before that I was going to show you a worksheet, and this is it. If you're trying to determine whether you're eligible for the low income exemption, in our expanded instructions and in our booklet, we have this worksheet there, and it shows you how to calculate your income for purposes of determining whether you're eligible for this exemption from filing a tax return. And probably the biggest thing on here is line item 2 is you look at your Iowa taxable income, and then you're required to add back the amount of your itemized or standard deduction. And then you're required to add back the personal exemption amount, which doesn't apply for tax year 23, and your QBI deduction and your net operating loss deduction. But the biggest impact is that itemized deduction or standard deduction. So follow the worksheet so that you can confirm that you are eligible, your client's eligible for that low income exemption. If you were eligible for a credit like an endowed Iowa tax credit, where there was a possibility that maybe, like in this case, there was a charitable deduction that could have been taken for amount that was contributed to a charitable organization, and then you received an Iowa tax credit. For Iowa purposes, you're still required to add back the amount of the charitable contribution that you reported for federal purposes if you want to take the tax credit. And if you, the place where you're going to do that is going to be on Schedule 1, line 11. You're going to give that a code of BB. Self-employment tax, and this applies to tax year 23. In tax year 23, if you were self-employed and on the tax year 22 return, you reported self-employment income, you paid self-employment tax, then you got a deduction for half of that self-employment tax. You may have been required to add back that amount of the deduction depending on your method of reporting that self-employment tax. If you added back the self-employment tax that was deducted for federal purposes in the same year. In tax year 23, you didn't have to do anything. But if your method of reporting was to report that adjustment in the year following, in tax year 23, you'd be required to add back that self-employment deduction that you had for federal purposes. But rolling forward to tax year 24, there is no problem. You're not required to make any adjustments. That was just a 1-year adjustment. And then teacher expense deduction. For federal purposes, teachers are eligible to deduct $300 of school supplies. And then for Iowa purposes, you're able to deduct an extra $200, a total of $500 you're able to deduct for Iowa purposes. The first part of the year, I think it was kind of corrected by the end of the year, but especially the first part of the year, some taxpayers were reporting a $300 teacher expense deduction for federal purposes. And then on the Iowa return, they were taking another $500 deduction, which is incorrect because the Iowa amount additional deduction should never exceed an additional $200 per taxpayer. So review that when you're preparing tax returns just to make sure that you have that correct. For tax year 24, a couple things I wanted to point out is we've kind of revised our position related to rounding. Last year, we indicated that everybody had to calculate their tax amount down to the penny. And if they didn't, some correspondence may have gone out. We've changed our position on the tax year 24 return. We're really kind of following the federal lead where you report amounts in whole dollars, but you can make an election to report to the penny. And if you make the election to report to the cent, then you need to do that on the whole return. You can't just pick and choose what sections you're going to report in whole dollars, what sections you're going to report in cents, but it's similar to the federal provisions. And then on Schedule 1, we had a couple lines, line 3 and line 4 were reserved for future use, and we've changed those. And what we're going to have you do on Schedule 1, line 3 is report any modifications that you're required to make related to a partnership or an S corporation. And those are amounts that are reported on that K1 before it was reported elsewhere on the return. But because we received so many of them, we gave it their own special line. And then the military retirement income exclusion, we're going to have you report that on line 4. So that's new for this year as well. And then, as I mentioned before, the surviving spouse pension exemption, that exclusion is just going to be lumped in with the other IRA pension exclusions on line 7 of Schedule 1. Amended returns. We've revised the 102 form for tax year 24, and what we've done is remove the financial section on that. Before, we had a section where we wanted you to identify like the original tax that you calculated and the revised amount and the amount of original credits that were reported and the revised amount. And then we're trying to tie that back to the return. So we were using this information so the examiners would have an idea of what changed with the return, just to make sure that the revised calculation for any refund or payment was accurate. Unfortunately, most of those calculations seem to be incorrect, and it's a lot easier just to remove that whole section. And then we just ask for a description of what changed on the return so we can validate that. Excuse me. On all the income tax returns, we've modified those to add some lines where you can report. And this is when you file an amended return, where you can report the amount of any refunds that were received for an original return that was filed, or for any tax payments that were made with that original return, so that you can reconcile down to a revised refund or liability amount. I think that's a good change for tax year 23. If you're required to submit the tax preparer continuation, continuing education form to the Department of Revenue. I just want to make sure that you know that you can go to GovConnect Iowa and you can submit all that information electronically to the department. That brings me down to the end of the slide deck. I'm going to look at some of the questions that we have out here. But that does bring us to the end of the presentation. If I don't get to your question, I'm going to try to respond back to you. It's my understanding I'm going to get a copy of all the questions and then information on whoever submitted it so I can respond directly back to you. I've got some questions on like some W-2s. Is there a way to get information if a business is no longer in existence? Typically, we tell people to go, to the Internal Revenue Service to try to get a copy of the W-2 form there, or the Social Security Administration to get a copy of the W-2 from them. We don't really have that information in a usable format to provide to anybody. So I can't really help a whole lot with that question. The next one asked about on the old return, taxpayers could file married filed separately on a joint return and split the income with the new return. Not having that, with a 50% requirement apply to the farm operator. Yeah, on a return, if you're filing married, filing joint, yeah, and you're trying to exclude, I assume you're talking about the breeding livestock capital gain exclusion. Yeah, 50% of the gross income reported on that return is going to have to be from a farming business. So your spouse's income is going to be included, and that could that could impact that calculation for you. What's the length of time to expect refunds from the state for the capital gain amended returns? I mentioned before we have, I think it's like about 6,500 amended returns that are out there. I can't give you a time frame on when those refunds will go out. We've been trying to process those as quickly as we can. We've been dropping the inventory substantially, but I can't give you a 60, 90, 120 day guesstimate on when those refunds are going to go out. It all depends on our inventory and the team members that are on hand to get those all processed. Megan, we're getting down to the final minute. Do you think that maybe we should close this and then maybe I can just go through these questions later on and try to respond to some of them?
Yeah, I think that's what we should do at this point. Thank you so much, Kurt, for going through all this information with us. And as a reminder, this webinar is recorded. It will be available to watch on our website or by searching Iowa SourceLink on YouTube within the next week. As Kurt said, if your questions were not answered today, which we have a ton, and we're still getting some in, so we will send all of those to Kurt along with your contact information so he can follow up with you. As a reminder, Iowa SourceLink does not provide a continuing education certificate for your attendance here today. We do, however, send out an email to everyone who participated within a few days after the webinar concludes, so you can use that as your proof of attendance. The next Iowa Department of Revenue webinar will be on October 9th from 11 a.m. to 1 p.m. Note the time change. The webinar will cover how to use the GovConnect Iowa system. Check out the registration link for more information. Visit iowasourcelink.com and navigate to our tax webinar page to sign up today. Until next time, have a great rest of your day.